Listen, nothing compares to permanent dividend paying life insurance. Why do I say that? Let me show you the best savings plan I know. A plan that does over 8% annually. Here's an example. This is a permanent dividend paying life insurance policy where my wife and I are putting in $200 a month for one of our sons, which is about $2,400 a year. We're doing this for 10 years. So that'll be $24,000 over 10 years. And we'll get about an 8% return. And you can do this just not only on a child, you can have a grandparent do this on a grandchild. You can have a parent purchase this on their own child, like my wife and I are doing. You can even have your child purchase this on your parents, which I have done on my parents. So let me take you through this example. So the first part, the reason I have the number 1 there is because that's the money that's going into this savings account, this plan. Now, column 2 is the cash value. And I explain cash value much like a house. When you purchase a house, you have to build equity in it. So you usually put your down payment in, and over time you build some equity. Now, the third column is the life insurance column. That's the death benefit. So if we graph it out, it looks like this. Column 1, which is the green line, is the money that's going into the account, the savings portion. So you can see mother and I, we put money in for 10 years and then it levels off because we don't put any more money in. Then line number 2, which is the blue line, is the equity that's building in the policy. And the red line, line number 3, is the death benefit. So stick to the end and I'll show you how to get instant equity. Does that sound good? If you look at the orange line, which represents line 1 and line 2 together, I'm going to show you a trick or a way where you can put $1 into the policy and instantly you have $1 of money to use for anything else. This is a cool little trick, but you have to stay to the end to understand it. So I'm going to walk you through this policy that my wife and I are doing on one of our sons. We put in $200 a month, so $2,400 a year. So at the end of 10 years, we'll have $24,000. Now, as you can see, the first year there is no cash value, not till about year 5, year 6, but I'll get to that. So by the year 10, we have $25,705 in cash, in equity, and we have $292,252 in death benefit. And because this is a permanent dividend paying life insurance policy, the dividends are helping grow the death benefit and grow our cash value. So now you can see here at age 16, our boy will turn 16 and most likely get his driver's license. And we've already have this place to go to for him to get an auto loan at a very good interest rate. And he can become an honest banker and he can learn a little about financing and paying this loan back. So we give him $24,000 that he borrows against this life insurance policy. That takes his cash value. The remaining cash value be $8,489. He'll still have a death benefit of $284,734. Now, he's going to pay this back every year, so $5,525. So when he works, he has to make payments back for this car. He'll be doing that, paying back the policy until age 21. At that point, the cash value is 100% reestablished, so he has $41,047. Now his death benefit is up to $323,916. Now at age 24, let's say he wants another vehicle. He takes out another $24,000. Notice the cash value goes from $44,637 down to $21,238. Still a nice emergency fund though, right? This leaves him with $307,497. Now he pays this money back again until age 29. At that point, the cash value is already established, which is $57,086, and the death benefit is still growing. Let's say he gets married at age 30, and then 2 years later wants to buy a house. So at age 40, he has $40,000. He takes that out for a down payment on a house. This leaves him $22,888 in his savings account, making a very good interest rate. And it leaves him with $355,700 $706 in death benefit. I'm going to pause here for a second and give you a side note. If he were to pass away at this point, that $40,000 would go against the death benefit. So he would not have $355,000. He would have $315,706. Now, because we have taught him to pay himself back, to pay the policy back with an interest rate, he's going to pay $2,700 back per year, all the way till age 68. And at that point, all the cash value is reestablished, $296,951. Death benefit of $506,473. Now let's say at age 70, he decides, you know what, I want to supplement my Social Security. He decides to take out $10,000 a year, every single year till he passes away, along with his other retirement funds and other things he has going on in his life. And let's say he passes away at age 94. So at age 90, he decides, you know what, I want more than $10,000. He takes out $14,000. Next year, $12,000. Next year, $12,000. At 94, he takes away $12,530 and then passes away. Well, he took out $261,472.72 out of this policy that Mother and I set up for him for $200 a month for 10 years. That was it. He passes away and takes out all that money. Plus, he leaves $238,713 behind for maybe our grandchildren, maybe for a charity, or however we have set it up. Some people put this money into trust, and they have to do exactly as the trust reads. But think about that for a second. He got $261,000 and left behind $238,000. Isn't that awesome? $261,472.72 cash out, plus the death benefit of $238,713 in death benefit. That's over $500,000 just because Mother and I, with $200 a month savings for 10 years, created this fund for him. Hopefully you can see why this is such a powerful tool. That's equivalent to an 8.36% rate of return, and it's guaranteed, no risk. So you might ask yourself, well, how exactly are you getting the 8.36? Well, the policy is doing about 3.45%, so a decent rate of return, but you have to remember, it's a tax-free return. If someone's in a 25% tax bracket, that's a little over 1 point in interest. And then we have a lot of people that always say, well, I think I can do better with a mutual fund or managed money. And we have to say, you have to remember, compared to what? If you're going to compare this, you have to use the alternative. Mutual fund's going to have a load charge or some fees on it. And usually it's a little over 2%. We've seen it as high as 4.5%. So we had, a little over 2%. But then you have to also buy term insurance because you're giving up the death benefit side, which is 1.7% interest. And then you'd have to do a 10-year or 20-year term, and you'd have to keep renewing it as well. So when you add all that up, it's comparable to an 8.36% return on a savings plan with no risk of loss. So can I ask you a question? Okay. If I can show you 3 different plans that start from $6 a month to the example I showed you, would you be interested in that? All right, cool. We call this our Silver Dollar offer. I'm going to give you a glimpse here. You get the Child Prosper Plan Report, which is a $21 value, emailed to you for free just by clicking the link below. When you do so, you will be offered the video report, which is a $297 value. Plus, you'll get 2 articles, which is a $79 value, and you'll get our Silver Dollar offer, all for just $1. That's a $397 value for just $1, $1. All you have to do is follow the link or go to thechildprosperplan.com. And remember, you can also share this with your friends and family members and tell them exactly how you get a better interest rate with no risk of loss. Because as you can see, it's not about getting a better interest rate. It's about getting more value for your dollar. Oh yeah, how to get instant equity, as I promised. So I want to give you an example here. When you buy a vehicle, there's two things going on. You can usually show up at a car dealership and you can pick out a vehicle and they'll run your credit and they'll say, you know what, we'll finance this vehicle for you. Well, you can do the same with life insurance. You can do the same with permanent dividend paying life insurance. You can come to an insurance agency or sometimes even a bank. I know for our insurance agency, you can say, you know what, I've heard about this thing called premium financing, which I'll get into later. I'll send you out another email on it. And you can finance the policy. What's kind of cool is when you finance the policy, just like you finance a vehicle, the bank or the institution that's helping you finance this will say, hey, we need some collateral. And they'll use the car as collateral. Well, most insurance agencies and banks can use your life insurance policy as collateral as well. Now, you lose out on the benefit of using the collateral yourself because you're tying up that money. But every dollar you put in that is not held as collateral, you can use to buy other things. You can use it to pay off a credit card. You can use it as a down payment on a house, to buy a vehicle, just like our example was for my son. So that is one way we can build instant equity by using these two things, premium financing, and we call it collateral assignment. But that's a whole nother topic. So once again, follow the link or go to thechildprosperplan.com. Again, please share this with your friends and family because, as you can see, it's not about getting a better interest rate. It's about getting more value for your dollar.